Welcome to the Property Mindset Podcast, where we explore everything real estate, from market trends to practical strategies for success. Our guests share personal experiences and valuable insights, providing practical tips and tools for your own real estate journey. Whether you're a buyer or seller, or an inspiring investor, a seasoned professional, or simply someone who loves real estate, this podcast is for you. So join us for engaging and informative conversations with some of the brightest minds in the real estate industry. Hello and welcome back to the Property Mindset Podcast, where we explore everything real estate, from market trends to practical strategies for success. I'm your host, Phil Gadd, and today I'm talking with Stephanie Roughhead, mortgage professional, about new mortgage changes and what they mean for buying and selling right here in Fernie. I highly recommend you listen to this one all the way through. It's a very much of a conversational piece, not much editing in this one, because there's some absolute nuggets in here if you're looking to get pre-qualified in this current market right here in Fernie. So welcome back, Stephanie, to the podcast. Great to have you back, and super interested to hear what you have to talk about the mortgage changes that we've got right now.
So a short break from our show sponsor, eXp Luxury at First Tracks Real Estate Group. Imagine a real estate experience where your luxury property isn't just seen, but showcased, both locally and globally. eXp Luxury is about more than transactions. It's about transforming how high-end properties reach the market. With a blend of unparalleled global exposure, cutting-edge marketing strategies, and an elite network of professionals, eXp Luxury ensures your property stands out in the luxury market. Phil Gadd and the First Tracks Real Estate Group leverage his platform to elevate your listings, ensuring it reaches its full potential. Welcome to the new standard in luxury real estate.
Yeah, awesome. Welcome. Well, thanks for having me, Phil. Always a pleasure to be here and chatting with your listeners. But yeah, lots of big changes happening recently in the mortgage space. So Canada's Minister of Finance, Chrystia Freeland, the Office of the Superintendent of Financial Institutions, they've been busy. Lots of announcements. So likely people are hearing these things on the news, maybe other social media, really with that focus that, our government does know there's a housing crisis. And so looking to bring some new reforms to ultimately help Canadians qualify to be homeowners. I don't think it hurts, or it's a coincidence that it's also an election year too. So likely that has something to do with it. But yeah, there's been a lot of talk, a lot of different like I said, focuses and things that are coming out. So wanted to jump on here, obviously, today to be able to share with people what those are, but more importantly, what they may mean to a borrower at kind of more of a high level. So if we go back to the first announcements, which started in September, there was actually 3 policy changes that were announced that are going to be coming into effect December 15th. So those are going to be all happening at that same time. So the first big one is the price cap for insured mortgages is going to be increasing to $1.5 million for everyone.
Okay.
So for simplicity's sake, I'm going to say $1.5 million, when in actuality it's $1,499,999.
Yeah.
That's a little bit too much of a mouthful. So we're going to say that it's 1.5, but that actually is the cutoff. So for people to remember, an insured mortgage is any time that you have less than 20% down payment. It is a requirement that you have the backing of CMHC, or the mortgage insurer. This is a Canada-wide policy. And up until this announcement, that threshold was $999,999 or $1 million, as we would say for simplicity.
Yeah.
So they are increasing that by a full $500,000, which is huge. Is a huge change. They haven't made a change to this since, I believe, 2012. So what does this ultimately mean now that you have the ability to have an insured mortgage up to 1.5 million? So really what this means is 2 different things for borrowers right now. It means that people can borrow with less down payment at higher purchase prices. So that's huge, right? I mean, I know in our market in the valley, especially in Fernie, right? There's a significant amount of listings that are over that seven-figure price point. And so now, or starting December 15th, for a purchase of up to 1.5 million, you now only need $125,000 as a minimum down payment, rather than current rules that say you would need 300,000.
Okay.
Yeah, so it's quite a bit, right? That's
Mm.
a large chunk of money. So, the other thing that people may not be aware of is that insured mortgages actually get better interest rates. So when you have a mortgage that is backed by CMHC, you get a better interest rate than somebody who has a 20% down payment, believe it or not.
Okay.
So now this gives people the opportunity to get into $1 million plus home with better interest rates, which ultimately are going to result in lower monthly payments.
Sure.
Um, yeah, so I mean, so good news for sure across the board there. One thing to remember, though, of course, as a CMHC insured mortgage, there's always a premium. CMHC charges a premium. It's added to the mortgage, and that's the case no matter what price point you're buying at. If you have less than the 20% down, and it's going to be, if you were to fully purchase at the maximum, the 1.5 million with the minimum down payment, it's going to be a hefty premium. It's about 57,000 that gets added to the mortgage. So it's not like this flexibility doesn't come with a cost.
Mm.
It does. But again, it is good news because it's going to allow more people who maybe don't have such a large down payment saved to get into a house that more aligns with what they're looking for.
Yeah, sure. Okay. So and so if you say we're going for the 1.5, your down payment would be the max, yeah, 300. Was that correct?
As of today, yes.
As of,
As of
okay,
today, any purchases over a million require a minimum down payment of 20%.
right.
Yeah,
Okay, all right.
yeah. So
Um,
that'll be a
yeah,
change.
no, that's cool. I mean, the way my brain works is, yeah, that's it's still going to be quite a hefty mortgage for someone. Um,
Well, absolutely. And that is what I would say. I don't even want to say some of the critics to these policy changes are ultimately saying, myself included. I mean, I won't lie,
yeah,
is you're right. I mean, it's not going to fix the problem by any means. And you're
yeah.
right, it's still going to be a very large payment. So for somebody qualifying at that price point, you're still looking at like a double income, strong income household, right? To
Mm,
have a mortgage payment of that size. It's just essentially allowing those who maybe, I mean, we're seeing more and more where family is helping with these larger down payments, things like that. So
sure.
this is just going to open it up for people that maybe don't have that ability. They've done their own savings. Both individuals in the household have really great incomes. They just haven't been able to come up with that, you know, whatever it is, $200 to $300,000 in down payment savings. So it's going to open it up for them.
Yeah. Also, I suppose the other way my mind works is I'm right in assuming that if you're buying a fourplex, that would still considered a residential mortgage, isn't it?
It is. Yes.
Yeah.
Yeah, it is. You bet. Yeah.
So maybe an investor who doesn't want to put like so much down could look at this and think, oh, okay, well maybe I could buy a few fourplexes for like 1.5 million with putting less than 20% down.
So yeah, so you have to be careful with that. If it was a fourplex and you were going to reside in one of the units, the
Okay.
multi-unit insured program would come into play, but
Okay.
that requires you or a member of your family to live in one of the units. Doesn't have to be you, but it would have to be a dependent or a family member.
Okay.
So if it's being bought as a pure investment property, rental policy would still come into play, which is lender dependent,
Okay.
20%.
Okay.
Yeah.
Right.
Yeah.
Right.
So
Okay.
a few intricacies there for sure.
Awesome.
Yeah.
Awesome. Good. Well, interesting stuff for sure.
Yeah. And so the next one that they announced too, along the same lines, is that all insured first time home buyers can now get a 30-year amortization. So another change again to these insured mortgages. This one I think is going to have more of an impact to our everyday Canadian buyer, especially for our first time buyers. So the amortization is obviously the amount of time it's going to take you to pay off that mortgage. And
Mm,
currently, as of today, for a buyer that has less than 20% down, they are only allowed to do a 25-year amortization unless it's new construction. And that's whether you're a first-time buyer or a fifth-time buyer. If it's an insured mortgage, you can only go to the 25 years.
Right.
So by allowing it to extend to the 30 years and essentially stretching things out for 5 more years, it does two things. It ultimately will save you in your payments each month. It'll lower your mortgage payments each month because you're now stretching it over a longer period of time. So to give you an idea, if you had a $400,000 mortgage, changing it from a 25-year amortization to a 30-year amortization saves about $200 a month in payments. That's the difference for that 5 years. So that helps a little bit on the pocketbook, obviously from affordability. It's also potentially going to help first-time home buyers qualify for more because a longer amortization equals lower payments, and which results in a higher mortgage pre-approval or a mortgage approval.
Yeah.
So if you previously qualified for a mortgage of, let's say, 530,000, if someone was pre-approved at 530,000 as an insured mortgage, so with a minimum down payment, now with this change being able to go to 30 years, you'll qualify up to 580,000. So it's going to increase people's budgets at that price point about $50,000 more.
Okay, interesting.
Yeah.
I've had an interesting thing on this actually, own personal experience. Currently got a mortgage with local credit union, residential. We're looking to get a line of credit to help out with some educational stuff and bits and bobs. And it got approved. And one of the conditions was that the current residential mortgage the current term went to a 30-year amortization instead of a 25. And I'm like, okay, that must be because of the new rules, which I was aware of, but I didn't realize that that would apply to that situation, but obviously it did. I mean, it's great for us because we pay every 2 weeks, and that payment has gone down significantly, which is great for affordability. But yeah, that's just something that happened recently to me. So
That would likely be actually so a little similar, but a little different, just in the sense of when you're actually adding, because you would have obviously more than 20% equity in the property. So
yeah,
adding a line of credit to the property is like under a collateral mortgage program. So
right,
they likely wanted you to perhaps stretch out the payment on the mortgage just to get servicing ratios to work.
okay,
Normally, that wouldn't generally be a condition for everybody necessarily. It's good that, and I mean, it works out great in your favor.
sure,
So why not? But yeah, the insured mortgages with less than 20% down have more stringent rules than when you
okay,
have more than 20% or more equity. These things have always been in play for those people.
okay,
It's just when you've been insured or less than 20% down that they're now making the changes to.
okay, cool.
But yeah, but very similar, but similar impact for sure.
Yeah, definitely. Yeah, no,
Yeah.
cool.
Yeah.
Just I want to ask a question. It's a little left field, maybe from where we're going right now, but is there? Do you in your industry? Is there like an average mortgage amount that like you would get average sale prices? Do you have that? Do you have that as a stat? Is that relevant, useful? I mean, I don't know, but I just popped into my head then when you were talking about the last one, and I just
Yeah, for sure.
is it something that you're as mortgage professionals look at? Is it something that I just curiosity more than anything?
For sure. Yeah, no, absolutely. I would say more on like a macro level. Like they know the statistics across Canada, but we don't
Right.
have anything like region wise. Not like, I mean, because the data is all over the place, right? I mean, I could have a client purchasing a $1.5 million home, but only needing a $300,000 mortgage,
Sure.
right? So, whereas somebody else could be buying a $600,000 home and having a $500,000 mortgage. So,
Mm.
it's really, I think across Canada, they're still saying, and I mean, there's so much disparity across Canada because, of course, you've got Vancouver and Toronto in there driving prices up. And then you've got, more rural settings driving prices down. I think it's still saying the average Canadian mortgage is on the high end of 400,000, like
Yeah.
400 to 450. But
Okay.
you're certainly going to find that's across Canada. That's an average across Canada. So yeah, unfortunately, not specific data
No.
to like
Sure.
area. Yeah,
Yeah.
but
No.
it would be interesting to see for sure.
Yeah. No. No. Definitely. And just because of the recent years where mortgages obviously have gone up, I think a lot of people probably, including myself, still have a really good rate for another couple of years, but
Yeah.
you'll probably get onto it. Well, we might talk about it, but the things coming down the road very shortly, probably including next week, we might start seeing rates, heading back towards those numbers anyway.
Yeah, well, and it's a good conversation, Phil, at this point, because you're right. Inflation numbers came in 1.6%, right? I mean, this
Yeah.
all started when inflation was at 8%. So, 1.64 on the estimates of 1.8. And really, I think as of this morning, when I did the check, 78% of economists and analysts are now predicting a 50 basis point rate cut at next week's meeting. So, which jumped huge on the inflation announcement. Prior to that, it was less than 50%. So just these inflation numbers really seem to solidify that. And, like to your point about rates, we've already, even just in the last year, and I want, to point this out for anybody listening, like waiting for lower rates. Rates have already come down. Like a 5-year fixed in the last 12 to 18 months has already come down 1.7%.
Right.
So it's also, when people are saying like we're waiting for lower rates, like people have to be really careful with that, right? Because where is the lower rate, So they're certainly much better. We're now, for a 5-year fixed, again, depending on your circumstance, if it's insured or not, low 4s, high 3s, those are normal rates, right? So there's obviously still room and work to be done on prime, which is what a variable rate mortgage is based off of. And that's what the Bank of Canada announcements directly impact, is prime rate only, not the fixed rates. So for anybody sitting on the fence that's like waiting for rates to go down anymore, I would certainly challenge that right at this point, to start saying like, hey, you know what? I don't know how much more we're really going to see in fixed rates, maybe 0.5%, right? Not as much as prime needs to go,
Yeah.
but prime bank rate and fixed rates are not directly correlated. So
Right.
they have come down. They're much better than where they were, for sure.
Yeah, for sure.
Yeah.
Okay, great.
Yeah, little side convo, but still important, right?
Yeah,
All of
no,
it.
definitely right now. So yeah, sorry, I'll let you carry on.
Yeah, no, all good. And just the last of the 3 first announcements was insured new build buyers can get a 30-year amortization. So this is now, previously they actually had changed this so that any first-time buyers who were buying a new construction could get the 30-year amortization. That's already in place. And now they're opening it up to say anybody who's doing an insured mortgage for a new build can get a 30-year amortization, not just first-time home buyers. So the first situation is only for first-time buyers, but now they're saying if it's new construction, new build, anybody, whether you're first-time buyer or anybody else, can get a 30-year amortization. So obviously this is the government's way of trying to incentivize people to buy new construction so that builders will want to keep building, which is really what Canada ultimately needs to do if we're going to do anything about the housing situation. We need to increase the supply. So that same results that we talked about before, that difference between the 25 and 30 year, but that this one in particular applies to anybody who's buying new construction can get the 30-year insured mortgage now.
Cool.
So,
yeah, awesome.
Yeah. So the next big round of announcements came shortly after. Again, it's been busy. These ones are actually going to start a little bit sooner on November 21st.
Okay.
And this one is actually talking about existing mortgage holders and what happens when they want to move their mortgage. So the announcement basically was saying that the stress test is not going to be required anymore when you are looking to move your mortgage to another institution, or what we call a straight switch. So like ultimately what this means is that, like, let's think about what the stress test actually is, just as a reminder for people. So the stress test is where when you get your mortgage, we are not qualifying and approving you on the interest rate you're actually getting. The stress test says we have to use a rate of 5.25% or the interest rate you're actually going to get on your mortgage plus 2%, whichever is greater.
Okay.
So this came out back in 2016, I believe it was. And honestly, thank God for it personally, because that is what is saving a majority of Canadians now coming out of their renewal, because if they had qualified at that 1.9 or 2.1% that they got, they would probably be in for some serious hurt now when they're coming up for renewal at 4.5 or 5%. But they qualified them at that time at 5.25. The challenge has been, though, now when someone's mortgage rate is 5 or 5.5%, they are having to qualify at 7 or 7.5%. And that's been really hard for a lot of people because obviously that's a substantially higher payment that they're having to qualify. So now when your mortgage comes up for renewal, if your financial situation has changed at all and your bank comes to you with a renewal offer, and they don't have to requalify you to give you that offer, but if they're not offering you something very competitive, obviously you're going to want to shop around, see what else is out there. But if you find a great rate somewhere else and now you're being told, well, I have to qualify you at 2% above that rate, you might not qualify for that. And so it was basically pigeonholing borrowers into staying with their current lender if they couldn't qualify at that stress test elsewhere. So
Okay.
to give like an actual example. So if like, for example, if you had $300,000 in a mortgage that was up for renewal or you were wanting to move it, assuming similar amortization, no debts, things like that. I'm just trying to kind of keep apples to apples here. But you would need to prove about $81,000 in income at a $300,000 mortgage. But after the change, and that's at today's rules, that's stress testing somebody on that 300,000. But after the change and no requirement to apply the test, you only need to show $71,000 in income. So it's about a 12% difference. So it's not huge, but for a lot of people, and I've seen it firsthand, it would make the difference. It was the difference between them getting to go for a lower rate or a better product somewhere else and having to stay where they are. So it's a good news story in the sense that people can now shop around easier and not feel like they have to be tied to something because they just didn't have any other option. But I do want to also remind people the stress test itself is not going away totally. This is something people are kind of getting confused about. We still have to stress test when we're qualifying people for new purchases. If you are refinancing your mortgage, like in your case, Phil, the scenario you talked about where you were getting the line of credit added, that would be considered a refinance.
Okay.
Stress tests still apply in those situations. But so it's really only when you are just, my mortgage is up for renewal at bank A, and I want to shop it around and take it exactly as it is at bank A and take it somewhere else. That is the situation where now they no longer have to add that 2% to the rate to qualify.
Okay, cool. Yeah, no, it's
Yeah,
good. Yeah, great.
yeah. So, and actually talk that I don't know, rumors in the market, rumors in the mortgage space is that we may see the stress test go away. It's hard to say. I mean, I find that hard to believe considering, again, it saved a lot of people over these last few years. But now that interest rates, are more normal again, maybe they're feeling like that might be something that could go. So we'll see. We'll see what happens with that. Who knows?
Yeah, for sure. No, I
Um,
mean, it's interesting. I mean, you could go into a whole another podcast about interest rates and what it actually means that the economy is actually doing. But I do sort of see recently things are just pulling back a little bit. I don't know if that's because people are waiting for this news on, lower interest rates, whether you jump in now or wait. I always say to people, very similar to what you said earlier, with kind of prices now, the where they are, especially in our market, which I still think we haven't seen the top anywhere close to be honest, especially with
mhm.
other markets such as, Canmore and Squamish and Whistler.
Yeah.
But prices are actually, they have gone up year on year, but prices are still fairly decent. And
Yeah.
one thing, in my opinion, if the market's going to be flooded with a lot of affordable money, i.e., at 3% instead of wherever we are now, 4.25, that's going to do one thing, in my opinion. That's going to drive prices up. So,
Exactly.
yeah. So get in.
More competition, right? More
Mm,
multiple offers. I mean, all of these rules are going to help more people qualify. I mean, if you think about even that, the first one we talked about now needing only the minimum down payment to go up to 1.5 million. Right now, the barrier to entry on that $1 million price point is having the 20% down payment, right? So now all of a sudden, that price, anything in that price space, you've opened it up to a whole bunch of people that qualified but didn't have the down payment potentially, right? So
Yeah.
more competition, multiple offer situation, right? So absolutely, yeah.
Yeah. So if you're listening to this and you are on the fence and you're thinking, well, blah, 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 I would highly recommend you speak to Stephanie and you get pre-qualified and then you come speak to me and we can go and buy your house.
There you
Yeah. Just
go.
Stephanie, what's the best way people can get hold of you?
Anyway, Instagram, Steph Roughhead Mortgages. Email me, stephanie.roughhead@dlcme.ca. Phone 250-423-9851. Text, whatever you prefer. So,
Awesome. Awesome.
yeah.
I pre-jumped the gun there. Is there anything, are you talking about anything more? Sorry.
You know what, Phil? We got one last one, and this is a good
Perfect.
one. This is a
Perfect.
good one. No, no,
Yeah.
no. It's a good one. I feel like we're sort of saving the best for last, especially anybody in a market that's got rental opportunities. So
Cool.
this third announcement is going to come into effect January 15th, and it's actually bringing back insured refinances for the purposes of constructing one or more suites on your property.
Oh, cool.
This one's pretty cool.
Yeah.
So again, what does this ultimately mean, right? That sounds like just kind of a lot of big terms and words, but refinances right now, and a refinance again is adding a line of credit, increasing your current mortgage, things like that. The rules were changed a while back that said you could only do that. You had to leave 20% equity in your property, meaning you could only borrow up to 80% of the value of it minus any current debt that you have on it. But starting January 15th, they're going to increase that to being to 90% loan to value, and which is going to be determined. And the cool thing about this too is that 90% loan to value is going to be determined based on the as improved value of the property with the suites that you're looking to add. So
Okay.
let's give a scenario, right? So we can actually put this into practice. So
Sure.
let's say
Yeah.
you've got a home worth $650,000 as it stands today.
Yeah.
So this owner wants to build a basement suite and a garage suite, above garage suite, right? So these additions, adding this basement suite, adding this garage suite, is going to increase the value of the home to 850, let's say, right? If all of a sudden you've got a nice suite above the garage, you've got a nice suite in the basement. And of course, Phil, you could probably better determine if those are accurate values, but we'll use them for the purposes of
Yeah. That's fine.
explanation.
Yeah.
Um, and so based on these new rules, they can now borrow 90% of the 850
Ah.
amount.
Okay.
So that would be 765,000 minus any existing mortgage amounts owing. So let's take it the next step. So now let's say that you have this individual has a $550,000 mortgage. So they can borrow up to 765 with these improvements. They've got a current mortgage of 550. This is going to give them access to 215,000 in equity or in funds, potential funds available for them to do these projects. So
Okay.
they've costed it out, and they can do the two suites for 150. Let's say they're going to be able to do what they want to do for 150,000. So at the end of the day, they're going to borrow another 150,000 to put in a basement suite and put in this garage suite. And let's say the potential rental income is like $3,000 a month, which I think is fair to say in our market. If you had a basement suite and a garage suite, I think 3,000 is probably
Yeah.
conservative, really. The cost to borrow this 150,000 is only like $800 a month. So all of a sudden now this individual, right? I mean, if you take off the cost of the extra funds they've borrowed,
Yeah.
it's still going to leave them $2,200 in surplus funds, right? After the fact, after they've paid for this additional lending.
Yeah.
And I mean, like sky's the limit for that money, right? Put it against the remaining $525,000 mortgage and you'd be done in no time, right? Or
Yeah.
help with cash flow. So this is really cool. And I think there's a lot of potential for this change in our market.
Mm.
So, I mean, you still do have to qualify under normal rules. But the other neat thing about this is that rental income can help you qualify.
Right.
So
Cool.
now you're getting 3,000 a month for these suites. You're
Yeah.
looking for more money to borrow. We can actually use the potential rental income to help you qualify. Does have to be long-term rentals. So that's been a point they've been pretty clear about. So no short-term rentals, regardless to what your municipality allows. The government obviously wants to see people giving long-term housings for people. On the side note, though, they haven't said how long it needs to stay long term for, so who knows? There might be an opportunity there. And of course, like anything, the suites have to meet your like municipality zoning and be self contained. It's got to be a proper suite, so own separate entrance, kitchen, separate bathroom, or sorry, separate bedroom, that sort of thing. So kind of no garden shacks being called a suite.
Now, and what's this program called?
You know what? They haven't really, there's not really a name. It's
Oh,
just
okay.
basically going to be, yeah, it's just a change to current rules. And like any new announcements, I mean, right away, I have, probably 10 different questions that haven't been answered yet. So, like any new policies, we're going to hear more of the details as they get closer to launching it. But it's just really a change to refinance rules that say you can now refinance insured up to 90% if the purposes are to construct more units on your property.
Cool. Yeah, that sounds great. I've actually got a real life example. I wondered if it would work because this is something that, potentially down the road that we're thinking about doing. Our current unit where we currently reside, it's big enough to potentially separate off, something we were thinking about doing, separating off, creating maybe another strata unit. That would be for us to live in, and then the other unit would be 3 beds. We would put a kitchen in. It'd have a dining room, living room.
Nice.
Would that work for a program like this? Do you
Yeah,
think?
I think potentially it for sure would be worth exploring, based
Okay.
on the rules. I mean, it is an insured program.
Right.
So, as long as it is going to fall under all the other insured rules, which are also changing along with this, right? So, yeah, I think there for sure could be potential
Okay.
here for that, definitely.
Awesome.
And it's great for Fernie because we've had the recent zoning changes too,
Yeah.
right?
Exactly.
So, yeah,
Yeah. And I've just had a client this week actually, this is perfect to go back to them and say, listen, do you know about this? Because that's exactly what they're looking to do. Buy an older house. It's got a full city lot. We've spoken about RSS, residential small scale, and this could be an option down the road when they want to, increase the dwelling size of that lot.
for sure.
Yeah,
Yeah,
fantastic.
absolutely. Yeah.
Good stuff. All right. Well, lots of amazing information in the last half an hour. So again, if you're listening to this point, well done. Thanks very much. Love to have you here always. And once again, Stephanie Roughhead, let the viewers know how they can get hold of you. So they've got two opportunities now to.
Yes, I appreciate that, Phil. You bet. You know what? 250-423-9851. Text, call, and then email stephanie.roughhead, only one H, ROUGHEAD at DLCME. And I'm online, I'm on Instagram. So yeah, I would love, always open for a chat, right? You never know if you don't ask. So
Exactly.
yeah,
And I think, especially with everything coming down the line, it's absolutely prudent to get pre-approved for anything that you're thinking about before. Before and whilst you're working with someone like myself, a local realtor here in Fernie. So, Stephanie, thanks once again for coming on the podcast. Like I said, lots of fantastic information in the last half hour. So make sure if you are listening, you go back and re-listen because you want to make sure that you are actioning some of this stuff. It's really good. Thank you.
awesome. Thanks, Phil.
So thanks for listening to the Property Mindset podcast. If you have any questions about buying or selling here in Fernie and want to discuss the Fernie real estate market even further, then you can definitely reach out to me. I'm always here to help. Stephanie has given her contact information in the piece. If you have any direct questions about mortgages, then please feel free to reach directly to Stephanie. So be sure to subscribe. If you like what you're hearing, leave a comment and share this episode with anyone you know who's thinking about buying or selling real estate right here in Fernie. I'm Phil Gadd. Stay focused, stay informed, and keep building the property mindset.